Hi, everyone, and welcome to the third session of the Financial Literacy Series. I am your co-host, Anthony Smalls, and we have another good session for you. This session is called Market Insights Beyond the Headlines. The market has a very dynamic system to it. People are always reacting to different events like global events such as pandemics or different things that they see on Twitter from a company. In this presentation, we will review what happens in the market as you on a daily basis, and if you should react to the things you see in the market. So we hope that you learn a lot today. We hope that you're focused. And for tips and hints, just remember that all participants, please remain on mute so we don't interrupt the presentation. Please pay attention to the chat function. That's where we will put links and downloadable documents for you as well. If you want to change your view in the top right-hand corner, screen, if you're on the computer, it says view. You can change your view, or you can change it on your phone as well, so you can see all the participants, or you can just see the presentation if you want to. Today's webinar is recorded. The first webinar is on our Mount Sinai Hospital YouTube page. I'll be adding it to our FOD mentoring section soon. I'm just waiting for the graphic art people to upload that section. If you have any questions, please feel free to put them in the chat. If you want to raise your hand, ask a direct question, please use the reaction function and raise your hand. And as a disclaimer, we will not go into any personal situations about finances, but we do want you to ask questions. We just don't want it to be too personal, okay? Okay, so we are welcoming back Ms. Kim Bourne and Kevin Hutt. So, if you missed the introduction, I will give you a short introduction on both of them right now. Kim is from Brooklyn, New York. You know how Brooklyn do. She's a certified, Kevin are both certified public accountant and certified financial planners. Together, they function as advisors to Advent Tax Wealth Management. Kevin's favorite motto is let's reinvent wealth management. Together, they manage over 100 assets around the United States. With that being said, we'll get into the first slide, and I will throw it back to Kim. Thank you all for joining.
Thank you, Anthony. Kevin and I are delighted to be with everyone in the Mount Sinai community and all of the affiliated organizations that have sponsored tonight's session and honoring Black History Month through education. As we prepared for tonight's program, we couldn't help but think of who do we want to highlight for Black History Month? What are some of the great contributors to our history? And it was a hard choice, but we narrowed it down to 3 basketball players. As we think about investing and doing it wisely, so important to have a game plan. So we are humbled and honored to have Brittany back on US soil. Yes. We know she's been through a lot of sacrifice and advancing women in sports and basketball in particular. Of course, the great Michael Jordan, and also honoring those that are no longer with us, like Kobe Bryant. It's a challenging period of time that we've lived through with the pandemic, with all of the uncertainty, inflation. We would be remiss if we don't continuously acknowledge everyone, not just at Mount Sinai, the great institution, but frontline workers and medical professionals across the country, for that matter, globally, for the personal sacrifices that have been made for our safety. We've seen the implications and the rippling effect of the pandemic throughout the markets, rising prices, downturns, just lots of noise, right? When we think we're overcoming, then we have setbacks. So we have upswings, downturns, panic, lots of pressure. We have to figure out a way to cut through some of this noise and be able to stay calm and focus on what is going to guide us, what is going to kind of direct our progress toward financial success. Wouldn't you say, Kevin? I just want to give Kevin an opportunity to welcome everyone and set the stage for tonight.
Thank you. And again, I echo Kim's sentiment. Thank you for having us. And we're very appreciative again of the healthcare professionals and first responders that got us through this past pandemic. It was really quite a miracle to really be able to come up with a antidote or something to deal with this within a year. So thank you. And we always say health is the best wealth, right, Kim? So thank you. And it's a delight to have us. And you're right, Kim. I like where you're starting off is there are a lot of things that are happening in the marketplace that are related to our daily lives that do impact your financial decisions. So I think you're spot on in saying, let's kind of come back to a central game plan to sort of guide us through this.
Absolutely. And with that, as we think of what guides us, Anthony, would you like to launch our first poll?
Yes, I am ready to launch the poll. Let me get that started. And as I launch the poll, as I said, I put the link to our first video in the chat for everyone. So just make sure you save that link if you want to see the first session on video. Our first question is, what resources do you mostly use to stay informed about the markets? Is it A, financial news websites, newsletters, or professionals? Is it B, TV news programs? Is it C, social media? Is it D, word of mouth? Or is it E, other? And as we get the poll coming in, we have 5 out of 10. So we'll give it a few more seconds. Just want to remind everyone that we are going to try to get you some type of gifts for your participation. We're going to pick the most active. So continue to answer the polls, continue to answer the surveys, and your name will be mentioned next week, which is the final session next Tuesday. Okay, we'll close out the poll in 5, 4, 3, 2, 1. And let's share the results. So most of the people pick financial news websites, newsletters, professionals. So that's just let you know that people are paying attention to the professionals in it as well.
Excellent.
Absolutely, absolutely. And when we think back to the decades, how much more information is just flying faster, more noise, more fear. I remember when I was in school, the primary way that news traveled was newspapers. I can remember doing current events when I was in middle school. That was how we did things. Now we have the tablets, the computers, the cell phones, it's just constant. But as I think back on my middle school years, not only do I appreciate how much information is traveling faster, but I also think back to my first experience with basketball. It was not a pretty situation. I did not attend a large school. It was a very small private school. There were no people coming around to scout, but somehow my classmates took this game very seriously during gym. And I mean, Kevin, I was just not coordinated. Dribbling and running and shooting, like those 3 things. Let me just try to master one skill at a time. No one would choose me. Volleyball, yes, I had a killer serve, but basketball, I just couldn't get it together. So one day I decided that, you know what, I'm just gonna grab this ball, and if I get it, I'm not gonna let it go, and whichever hoop is closest, that the ball is gonna go inside of. And so said, so done. I felt like, where's the team spirit? Where's the coaching? Like, why are we not like functioning and wanting everyone to succeed? So I got the ball, I held it close to my chest, and I looked left, right. I said, okay, that one's closer, and I ran. And I got there and I could hear a pin drop. I wasn't any cognizant anymore of what was going on. I was just focused on getting that ball in a hoop. And I shot, and it went in, and I said yes. And everyone's looking at me like I had just lost my mind. What did I do? I guess if everything was shut anyway, because people were so taken aback, it was almost time to eat lunch. It was a wrap, but I scored a point for the winning team. It wasn't even the hoop that I was supposed to get the ball in, but it went inside, right? And that's all that mattered to me at 10 years old. At least I could do it. Right? that type of behavior now, that's not going to cut it. Playing a serious game like basketball, especially at a professional level, we got to have a game plan, and our lives are serious. Our goals are serious. We have to have a strategy and proper coaching, because many things are going to impact our investments. Political control may not impact the markets, but there are reactions and so many different moving parts. You know, when we look at this slide, we realize regardless of whether we have a Democratic Congress or a Republican Congress, markets perform in both situations. But whenever an election is coming up, there's a lot of hype and a lot of distractions, and very easy to get caught up in those things and who's going to be in office. Investing has become increasingly complex. There are more products, more types of names that are being thrown out there, passive ETFs and smart beta funds, private equity. There are more geographies. We have international, we have global, we have developing markets, we have emerging markets, and no one wants to miss out on the action, the countries that are up and rising. So with greater complexity and lower bond yields, it's pushed investors into different types of asset classes that can be more volatile. We did a session on Bitcoin. Everyone wants to find ways to make some more money, and we find ourselves having to take on even greater risks to get similar returns. So tonight we want to encourage you to approach your investing with that spirit of sportsmanship and gamesmanship, recognizing three key things, just as with basketball or many sports for that matter. We got to set our playbook in advance. We can't just, do like I did when I was 10 years old. Like there's a reason why as we get older, right? Those first grade desks, they don't fit us anymore. We have to become a little bit more sophisticated.
Yes.
And more about doing things. And then also combining our offense and our defense. There's a time in life to be offensive, and there's a time in life to be defensive. A time and a place for everything. And then third, just differ our plays for different markets. I always remind my kids, you can't go through life with a hammer and treating everything like it's a nail. You got to differ your plays for different markets. I think that was a quote by someone, and that one always stayed with me, right? Because so many people, they just have one tool and they just try to just bang at everything, and that's not going to work. So during our time tonight, Kevin and I are going to take these three concepts apart slowly and put them back together for you in the context of your investments. And I'm thinking by the time we reach the top of the hour, you're going to have some strategies so that you can set your playbook in advance. So Kevin, tell us how to put that in motion.
Thank you, Kim. And I was also picked last on our playground basketball team, and there were times, Anthony, when they would pick someone that was younger than me. And that was embarrassing. And actually, so it's kind of the playground approach to choosing members of the team. And the NBA All-Star game was this weekend, and that's how they now choose teams. LeBron's a captain, the other guys are captain, and they pick and choose the best who they want on the team. So needless to say, I was one of the last people picked. But I think you're so right in terms of having a strategy and a playbook in advance. And I'm reminded, as we're talking about historical figures, one of my favorite, I was watching this documentary on Bill Russell, just a phenomenal civil rights advocate. And one of the things he said about having a playbook is he said, I'm quoting him, "Success is a result of consistent practice of winning skills and actions." Success is a result of consistent practice of winning skills and actions. And that's what we're talking about. And he says, there's nothing miraculous about the process. There's no luck involved. So here, I think Kim and I tonight are talking about setting in place a practice of winning skills and practices. So when we look at an investment portfolio, a lot of times that consists of several different things here. We want to kind of say, when you're on a team, kind of every player has a role, and they all work together for one goal, which is usually to win a game. So what fuels your team's success is when every player does something different. Our stocks are going to do something different than our bonds. One part of our portfolio may be offensive, the other may be defensive. So the key, though, is that the team is following a consistent playbook, and the playbook is adjusted for different teams. It is adjusted for different times of the market, as Kim mentioned in that screen, where there are a lot of things that are affecting the market. Sometimes there's a need to adjust that. But we want to have a strategy to do that. So when we think of just the world of opportunities out there for investing, it's significant. I mean, there's $163 trillion in stocks and bonds. So typically, though, you'll see a well-built, well-diversified investment portfolio is really the best team. And in this last year, where we've had really some very cyclical investment performance, all the conversation will tends to fall back on diversification. What's your combination of stocks and bonds, offense and defense? When we talk about stocks, and that term's used often, what does it mean to invest in stocks? So let's do kind of a quick review of just stocks and equities. And essentially, when you own equities, you have a stock, you have a kind of a ownership in the company. You invest in these equities and you benefit from dividends. So as these companies are profitable, they tend to pay out dividends. You also hope that the stock appreciates, sometimes as a function of performance. If that company is doing well, the value of that stock may go up. It can also go down. As stockholders, going up is what we refer to as capital appreciation. I want to invest $100 today, and I hope that that $100 share grows to $150. That's going to be a result of that company's success. As a shareholder, you have an ability to vote. So there may be board members that are being elected to that company. So you have kind of the ability to vote and have some say-so in that company. There are several categories of stocks when we sort of begin to look at them. And if we could convert to the next slide, you have different categories of stocks. Some are varying by different degrees. Some are long-term, some are short-term. But here you can see that the stock prices tend to maintain some growth over time. That's my solar light working. I'm energy conscious. Let's go to the next slide. So here, over time, when we compare stock prices, over time, they tend to grow in value. A lot of times, when we're looking at stock prices, one of the things we use to value stocks is what we call the PE ratio, which is essentially looking at the price of a stock compared to earnings. But at the end of the day, when we really look at stocks, it's going to be about quality. When we look at quality, we always say quality kind of matters when we're looking at different stocks. The different types you see there, technology, staples, utilities. A lot of times we're wanting to look at the performance of stocks and their quality over time. So in many respects, active matter, when we look for quality in companies, we're looking for a couple of things. We're looking to see if the company has competitive advantages. When I think of Tesla, they have competitive advantages. Do they have strong financial positions? When I think of strong financial positions, I may think of Ford or GM. Do they have a history of earnings that have been growing over time? Typically, I'm looking for a company that has that element. What's their operational performance like? What's their management team look like? So we typically believe that it's quality companies that really have growth and value over the long term. As you can see, pretty much that's what this chart kind of highlights. Why don't we do, I think we have a poll coming up next. Why don't we do this next poll, Anthony?
Yes, let me get to the next poll question. Okay. What is your approach when choosing an investment strategy? Is it A, I rely on a financial advisor or investment professional to choose a strategy for me? Is it B, I conduct extensive research and analyze before selecting an investment strategy? Is it C, I look at the surface level information like the price, dividends in the company? D, I tend to follow the advice of friends, family, or colleagues when choosing investment strategy? Or E, I do not currently have an investment strategy. So just remember, there's no right or wrong to this question. We're just gauging. Do you have an investment strategy in place? It's nothing wrong if you do or don't. Okay, we're at 8, and we will end the poll in 5, 4, 3, 2, 1, and share the results. Currently, it looks like everyone picked investments. I do not have an investment strategy right now. So that was 4. And the next one, I rely on a financial advisory investment professionals to choose a strategy for me. So that's a good gauge.
Yeah, that's excellent. I think that's an excellent gauge. Can I just spend a few minutes just while we're talking about stocks, just to highlight the different types of stocks, and then Kim will transition to you. Is that okay?
Absolutely.
So when we think of the stock environment, there are kind of 3 broad different areas. So there are stocks that are domestic companies. They're typically going to be your IBMs, your Microsoft. There are stocks that are international, and they tend to be companies that are outside of the US. There are stocks that tend to be global, and those will be companies that may invest both in Europe and in the United States. There are stocks that are in emerging markets. They are found in developing economies like China, et cetera. So I think when we start to look at stocks and we unpack that, there are different types of stocks in different areas. Typically, the domestic stocks will be kind of well established. They tend to give you a steady rate of return over time. The international stocks, you're hoping that these countries are now becoming industrialized, hopefully democratized, and will start to begin to offer greater rates of return. So just a little bit about sort of the different types of stock. Kim?
Yeah, absolutely. And as Kevin winds down from helping us to figure out how to fit all of those different stocks into our playbook, it's kind of a nice segue into making sure that as we set our playbook, that we combine both offensive and defensive strategies. So the offensive strategies are those assets that have a higher potential of returns, those types of stocks that Kevin described, developing markets, growth that are focused on appreciation. That would be an offensive position, because we're really looking and seeking to drive that ball, move our investments forward. When we think about a defensive position, on the other hand, those types of investments are focused more on minimizing risk and preserving wealth. These types of strategies involve predictable types of returns like bonds, CDs, other types of fixed investments that have a duration that's going to be more in line with a short-term goal. So people that are closer to their goal, whatever that be, whether that might be retirement or purchasing a home, something where it's going to be coming up in the future. You're not going to want to be very offensive in terms of how you invest those funds, because preservation of capital is paramount. Growth or value, that's always the scale that we have to kind of balance as we think about how are we going to allocate into the different types of investments that Kevin spoke about. Some investments are focused on growth, but then there's that type of contrarian view that says, maybe I want to invest in things that we might think might be trading at less than their true potential in in the goal of achieving more over the long term. So we also have to spread our investments, not just thinking about different sectors or different geographic regions, but what's the objective of the manager? Is it purely growth, or do we have more of a contrarian view where we're going to be seeking value? And opportunities present themselves in different ways and for different portfolios. We find that there are different industries that will present some interesting opportunities. So as we look at the 4 quadrants in this slide, we see that we have a gaming slide. For decades, that type of technology, new ways to play. There are industries that are actually have a growing user base in these types of game developers. So there are opportunities there. Below that is a wireless tower. We see that the 5G networks, those networks that are driving our technology, our cell phones, radio spectrum. 5G is still in its early stages, but industries will likely be transformed over this massive Internet of Things and mission critical services. So lots of opportunity for growth there. On the other side of the quadrants and spectrum, when we think about value, there are a couple examples of industries that are value focused. Some types of industrial companies are well positioned to improve the efficiency of buildings. We want to focus on reducing carbon emissions and find, what are we using as with raw materials, our paint, our plumbing, which are more high margin. So lots of opportunities there. And insurance companies are also well positioned. Currently, their valuations are making them attractive. So these industries are very different and help us to diversify our portfolio. It's all about finding quality companies that can grow earnings over the long term, and we have analysts that will help to do that work, because that is a full-time job to really analyze the various industries, the various companies, and find the excellent opportunities to invest in. What role can international equities play? Well, Kevin said it all. Obviously, different countries, different regions, the third world, lot more risk, foreign currency risk can come into play. So many different moving parts, again, when we think about global investments, but that doesn't mean we shy away from it. International investments, over time have been quite disappointing sometimes, but still important to have some diversity. I always say, never bet against America.
Yes, that's a good one.
Never bet against America, but still it's important to recognize that, right, we have to rise in the face of globalization and recognize that many different companies have great offerings, and many American companies obviously are also doing business overseas. So lots of exposure to capture the returns that are provided by a global economy. And we do want to always make that case for international equities. I'm not going to go too deep into the different countries, because, even financial advisors may say, oh, internationals equities have been lagging for some time, but everything is specific to the investment that you hold, and just want to find that right balance for you. This slide here, a tale of two companies, represents two apparel companies. One is US domiciled and one is global. Now, although the US based company is over 4 times the market cap of the global one, the diversification of the revenue exposure is higher, and the dividend yield and solid PE, that price to equity ratio, demonstrates potential that you may be overlooking if you are only looking at US based stocks. So this is just another slide to kind of drive home the point that we need to, despite the fact that international returns have not kept pace with US stocks, there's still that place, because the tide can kind of shift at any time, and you want to be well diversified. And the same is true for investing in bonds. That would be that defensive position. Everyone, we work hard to accumulate our assets. And as we think about Black History Month and African Americans rising in wealth, it's new wealth, not just for African-American families, immigrant families. There's a lot of emerging wealth as the United States is that kind of melting pot that we open our shores to everyone. So we have to, in some cases, think about not just how we're going to build that wealth, but how are we going to preserve that wealth? And that is where bonds can provide some value. Not investing in them for growth, looking at the interest, we're in a high interest rate environment now. So just really selecting the right types of bonds, whether it be corporate bonds, government bonds, in some cases, municipal bonds that offer tax-free returns on investments. They too can have a place in an investment portfolio. The inflation bandit that's robbing investors of return. What's that bandit? These rising interest rates. Pretty much inflation will erode low investment returns. So it really is a bandit. For decades, inflation was quite low, but we see how it's ticking up. We're seeing the challenges in the supply chain. We're seeing how prices of materials, building materials has just escalated. So, more and more it's becoming real, why we have to seek higher returns, and we're seeing how inflation rates have moved higher. Historically, inflation has had a greater impact on our wallets than our portfolio. So food and energy prices can be a major driver of inflation. And as we think about healthcare costs, that is a big expense to kind of factor in, not only during our working years, but as we get older, thinking about managing these costs and how much more expensive healthcare is becoming. And bonds have provided some diversification in times of stress. In this environment, many of you may have been thinking that you don't want to own bonds because they don't grow really, right? But this chart shows that bonds do play a role in a diversified portfolio in all environments. So historically, when stock prices fall, bond prices have risen, and bonds historically have helped to counteract that equity volatility. And in today's world, volatility seems like it's the only certainty.
Yes.
Just moving forward there. And it's also important to recognize that not all fixed income categories perform the same, right? Just as Kevin mentioned, there are many different types of stocks. There are many different types of bonds, some that I've touched on already, whether they be corporate bonds, government issued bonds, those bonds issued by state and local municipalities. They're not all the same. So it's important as you build out your portfolio to find the right one for you. At the end of the day, it isn't a basketball game, it's a numbers game, right? What do these declining numbers represent right here? Well, when you look at these numbers, these are your average annual returns from Bloomberg's Barclays US Aggregate Index in the 80s, 90s, 2000s, and 2010s, from 2010. So why these returns are significant? You're looking at 12.4% average weighted returns on stocks versus going all the way down to average returns on more fixed type investments. So these numbers play a big difference. Some of you might be familiar with the rule of 72 that tells you how long your portfolio takes to double if you divide an interest rate. So if we just use the round number like 12, 72 divided by 12, if you're getting a 12% rate of return, divide 72 by 12, every 6 years your money is going to double. Whereas when you think of a lower rate, if you're thinking of a rate closer to like 2%, and divide 2 into 72, that's going to take 36 years for your money to double. So money doubling every 6 years versus every 36 years, it's a big difference. It's kind of keeping things at the opposite ends of the spectrum just to drive home the point. It really is a numbers game. So that falling rates, a key driver for fixed income returns. There are some banks now, CDs offering over 4%. Right, so if interest rates are rising, where you can pretty much park your money with very little risk, that's having its play as well. So definitely, I would say you want to take advantage of that. Make sure that any cash position that you have is earning the highest possible rate of interest that it can, and that we're not losing sight though of the longer term, because interest rates, some project they will go down. We have to wait and see. No one knows for certainty.
It's true.
But just important to just not allow whatever is happening in the short term to overshadow what we want to accomplish in the long term. With your, with this slide, you have a great interest rate checklist, kind of showing the highway of what's driving interest rates in both directions. So if you think about it from a northbound, what's driving interest rates up? Typically government spending, consumer spending, inflation, and economic growth, versus what might drive interest rates down. We do have an aging population and increasing demand from investors, technology disruptions, as well as high debt burdens. So these things are constantly moving, ever changing, short-term versus long-term considerations on inflation. Two biggest driving factors are the supply chain and rising energy costs, right, which are closely related to reopening of the economy. So the short story is there is always going to be many factors, production costs, everything that kind of falls into this category on a macro level outside of our control. So I wouldn't encourage you to get too caught up in that noise. Just kind of think about things on a very basic level. Fixed income investing 101. Just understand that there are different types of investments. You have different types of goals. And I think the key thing here is to always play offense, both defense, and make sure that your investments are aligned with those goals. And with that, let's launch our third poll, Anthony.
Yes, let me pull up the poll. That is number 3. Yes, the poll is launched. How do you balance offense and defense in your investment portfolio? Is it A, aggressively pursue growth opportunities? B, prioritize risk management and capital preservations? C, aim for a balanced approach between offense and defense? Or D, not sure, don't have an investment portfolio yet? So there's no right or wrong. We're still just trying to see where your mindset is at so we can move forward. I see we have 7 participants, 8 participants, 9. That's great. So we will close the poll in 5, 4, 3, 2, 1. Share the poll. And the majority of the folks picked C, aim to balance an approach between offense and defense.
Excellent. Excellent.
Excellent.
Well, you did just such a marvelous job of talking about bonds. There's my solar light going out again, and coordinating that. And I think you're right. I mean, the market is ever changing. So having that game plan allows you to have a sort of a sense of stability while everything is changing out around you. And you have to be able to triangulate. Rising interest rates can be beneficial on one hand, can hurt on the other. So I like your discussion about how effective bonds can be used in your portfolio, both offensively and defensively, which kind of leads into what we're talking about this next slide, where you differ your plays for different markets. Here's just some, terms of markets you've heard about. I know we all know them, but I think it's great to just spend a few minutes just kind of highlighting kind of how these markets are defined. So when you think of the stock market, a stock market is a system for buying and selling stocks or shares of ownership in publicly traded companies. One of the things about the Dow Jones Industrial Average, which is kind of a barometer. I always look at the Dow Jones and S&P as really gauges. They're temperature gauges. They really are used by an investor to give us a feel for how the market is doing. But the Dow Jones is really a complicated average of 30 companies. Most of them are the most larger companies like Microsoft. I think Tesla may be in there, GM. But the Dow Jones Industrial Average is an average of these 30 companies. And those average prices are averaged every second of the day. And by looking at these averages of these 30 companies as an investor, I can get an inference about how the market is doing. If the Dow Jones is up for these 30 companies, I can infer that the market is doing well when I make investment decisions. If that gauge is down, I can infer that the market may be down a little bit. If you've heard of the S&P 500, which stands for the Standard & Poor's, it's an average of 500 domestic companies. So a larger sample and an average just to gauge what's happening in the market. But the stock market is a very important tool for companies to raise capital and for investors to participate in growth. The bond market, Kim spent a lot of time on that. That's where investors go to buy and sell debt securities. You know why bonds are called fixed income securities? You've probably heard that term, and why sometimes they can be effective for retirees is because bonds are really debt instruments. If I buy a bond from IBM for $25,000 that has a coupon rate of 4%, maybe 5% now, Kim, given inflation, that is a commitment by IBM to pay me back my $25,000 with 5% interest a year. That commitment is fixed. Doesn't matter what the stock market does, and go up, down, turn around, flips, those commitments are fixed. So you can see how those positions in the bond market may be a little more safe and secure. Certainly, believe it or not, the foreign exchange market, which is known as Forex, just some interesting thing, it's a global decentralized market of trading currencies. But believe it or not, this is the largest market in the world. And it operates 24 hours a day. A lot of times you have these global companies, you know, they're looking at what's the price of goods here, or what's the price of supplies there, and currencies can make a difference. Commodities market, essentially that's a market where there's a trading of raw materials, gold, silver, oil, agriculture products. So those are just some things about some key markets. Just a couple of terms that we're familiar with. When someone says it's a down market, what are they really saying? Well, it's a period in where the value of your investments are declining. Now, Kim pointed out a little bit of that. There can be a variety of factors that affect that, economic downturns, political instability, company-specific issues. And then when you hear the term up markets, I'm still on the markets tab. Kim, if you go back just one more tab.
Go back.
Yep, I'm still there. Thank you. When I'm talking about upward markets, we're talking about a period in which value of investments are increasing. And this can be because of economic growth, positive company news, and market-wide optimism. So now let's go to this next table. Now, for you physicians, this is not a periodic table, okay? But basically this table, but if you tab between 37 and 40, when it's all said and done, diversification has paid off. And diversification, in my mind, means, in our minds, it's a balance between different positions. If we're talking about a basketball team, I may need someone who's a point guard. I need someone who can rebound. I need someone who's offensive. So same thing with investments. Stocks and bonds behave differently. Different types of stocks behave differently. Domestic stocks may behave differently than international stocks. So here you want to make certain that your portfolio is well diversified. That's the key of these next three tables. If we move through to, let's see, the next slide, again, another periodic table. We'll go to the next slide and kind of, I think,
Chart key.
We'll go through that.
The next slide would be a poll.
Yep.
Next poll.
Next poll. Yep.
Okay.
Anthony.
With next poll, let me share the screen. This is a rapid fire round robin, true or false. So I'm gonna launch it and we'll go one by one. So true or false? The stock market only includes stocks of US companies. Is that true or false? Then number two, the bond market is generally considered a low risk investment than the stock market. Is that true or false? And then last question is, in a downward market, investors may be more likely to sell their stocks in order to limit their loss. Is that true or false? We'll give you some time to fill out all 3 true or falses. Remember, we're still gauging engagement with the attendees to see who will be up for a chance at a prize. Okay, see 7 responses. Okay, we'll close out the poll in 5, 4, 3, 2, and 1. Share the results. Okay, so it looks like in our first question, true or false, the stock market only includes stocks of U.S. companies. False. That is correct. They include stocks from outside companies as well. Interesting documentary on Netflix about outside of U.S. stock market companies taking advantage of the actual stock market. Number 2, the bond market is generally considered a low risk investment than the stock market. Everyone picked true, and that is correct.
Mm-hmm.
And then the last question is, in a downward market, investors may be more likely to sell their stocks in order to limit loss. And a lot of people pick true, and that is correct.
Fantastic. Well, thank you, Anthony. So when we, our audience, by the way, so when we, at the end of the day, talk about considerations for long-term investors, and we've talked about diversification and building a well-diversified portfolio. We've talked about, as you know, we've experienced a lot of ups and downs in this last year. Here are some questions that you should be asking yourself when you're dealing with your investment considerations. What is your time horizon? If I'm retiring in 2 or 3 years or 3 to 5 years, I generally want to be more conservative than if I've got 15 or 20 years to invest. What type of investment makes sense for you? Given your risk considerations, is it stocks, is it bonds, is it a combination of all the above? What level of risk are you comfortable with? We always know that, Kim. People want the moon, but sometimes they're scared to step out of the cab. So you want to really balance your risk and what you're comfortable with. And then sometimes you need a coach. You need a financial coach sometimes to help you through these systems. And Kim knows a lot of times we spend with clients helping them really go through these questions and navigate through a game plan that at the end of the day is consistent with their time horizon, makes sense given their risk comfort level and their expectations. Kim?
Yeah, no, absolutely, absolutely. See, that's what I needed in middle school, a dynamic game plan that showed me where to go. Absolutely.
A coach.
And a coach like Doc Rivers to help me to implement it. So with that, let's launch our final poll for the evening. What will be your next steps, Anthony?
Oh, that's the next poll. Okay, 1 second. Let me go back to the screen, launching the poll. Can you briefly, before I launch the poll, can you explain the true and false, why they might be wrong, right and wrong, if that's possible? There was a question in the chat.
Let me go back to that slide with the true and false. This last poll here.
Yeah, you want me to just share the results? So that way it's up on the screen?
Okay.
Okay.
Absolutely.
Cool.
So they wanted to know why would the questions be right or wrong or false?
The stock market only includes stocks of U.S. companies.
Mm-hmm.
And most people answered correctly.
Okay.
False. So as we talked about before, lots of different types of investments out there. The stock market includes companies in emerging markets, right, and developing countries. Yes. So there are opportunities out there that everything is not just in the United States.
Yeah. And right? A lot of times, Kim, when companies want to raise capital, where do you raise it? In the US stock market. So a lot of times you'll see those startup companies ringing that bell. They're essentially the biggest driver of coming to a US stock market is to raise capital.
Exactly.
Finally, as Kim said earlier, you never want to bet against America. You know, if I want capital and I want investments, probably it is probably America offers one of the most stable economies, the most stable economy in the world.
For sure, because foreign exchange rate risk is a real risk. Just outside of the volatility of the companies, you know, to Kevin's point about the stability of the American companies, you know, there's a stability of the American dollar. So oftentimes, you know, wherever you travel, we're still the benchmark. So that's as currencies are devalued relative to the US dollar, that can create another risk, even if a company is performing well. So lots out there to swallow.
And number two, I think your question is, why is that true? Bond markets generally considered lower risk than stock markets. Kim had highlighted that a bond is a debt agreement. So again, a bond has, if I buy a bond from General Motors for $25,000, those commitments are fixed. Let's say it's a 5-year bond that pays 4%. 5 years, General Motors will give me my $25,000 back. That's a fixed commitment. And I will earn 4 or 5% every year for 4 or 5 years until that bond matures. So again, there's pretty much no risk there, right? Because that's a debt commitment, almost like a loan or a mortgage. So that's why those instruments seem to be less risky versus if I buy $25,000 worth of General Motors stock, that $25,000 could be 26, could drop to 22. So that's why bonds tend to be lower risk investments.
Absolutely. So the only way that you lose money with a bond is if the company defaults.
Yes. Yeah.
And so, you know, typically governments, they don't want to default. Not that it's never happened or it couldn't happen, but it's just less likely, because when a major company does not pay the bond, it's just like an individual. They're rated. They don't want their scores to go down. So they have a lot of vested in making sure that they have AAA rated bonds, AA rated bonds, and that they're not going to default. And then finally, in a down market, investors may be more likely to sell stocks in order to limit losses. And, you know, that we can sum that up by saying investment return is not synonymous with investor return. So an investment can have a great return, but if we don't hold it, we don't get that return. And our human nature, unfortunately, as soon as we see something declining, there's an urge to say, I got to stop the bleeding. I got to stop the bleeding. Cut it.
Yes. Yes.
Yeah.
And that's why, Kim, that game plan is so critical.
Right.
Because you don't want to be too overexposed in stocks when you shouldn't be. Good segue into your key takeaways. Yeah,
and we'll wrap it up as we get to the top of the hour. If there are other questions, what we did, pre-submitted questions, we put the responses to those questions in the slides. So if you download the slide deck from the chat, lots of questions come in. We don't have a time to answer every single one, but we want to make sure you have valuable information. So they're in the slide deck. And so as we wrap up, just reflecting again on those key takeaways, that playbook. You know, when we see Michael Jordan with that ball, I think he is the epitome of all 3 points, right? Always make sure that you have that game plan. You know, here is someone who not only rose to the top of their game, but left the professional sport at the top of their game to pursue other entrepreneurial adventures, and his net worth just continues to grow. So he's a great example in many ways of all that we can aspire to in our investments, right? Being able to diversify positions. Again, we saw Michael Jordan just master the court, right? And play offense, defense. And finally, pivoting your plan for different circumstances. Yeah, leaving at the top of your game. Great Netflix series that Michael Jordan has on Netflix.
Last Dance.
Last Dance, absolutely. Absolutely.
I watch it over. My wife says, "Are you watching this again?"
so many life lessons, right? So being able to really differ your plays, and when we can continue to learn a lot from the sport, from all of the people who have contributed to the sport, from all of the people whose backs and shoulders that we stand on during this Black History Month. We hope that you have found a lot of value in tonight's segment. Kevin and I look forward to joining you again next Tuesday at the same time. We hope that you will track your financial progress and utilize all of the resources that we have shared. And we'll hand it back to Anthony to close us out for tonight.
So again, thank you all for joining. Greatly appreciate you joining our third session. As I mentioned before, our first session is up on YouTube. I'll put it in the chat again. If you check the chat area, we have our Survey Monkey too as well, that you just want to figure out if you are tracking your progression with your finances. We want you to look at the first session, and once the second session is up, I will share that video footage with you as well. Please remember that we'll be here next week, Tuesday, for the final session. We greatly thank you all for continuing to come and participate in this. So thank you all for coming. Have a wonderful night, and we will see you next week.
Yep, navigating some of the do's and don'ts of wealth building next week is the session.
Okay.
Thank you, Anthony.
Thank you.